The current bull market in gold is in full swing, and this promises to be the biggest one of all. So it makes sense that you want to know how best to profit from it. There are 4 playing fields in which you can participate depending upon your finances and your flexibility. You can buy bullion directly, and this can be done through investment bars, gold coins, gold nuggets, even gold jewellery. You can buy instruments, and by instruments I mean things like futures, options and warrants, and gold certificates. You can buy real estate, or you could buy gold equities. Running through these quickly, you can buy the real McCoy, you can buy gold itself. The most sensible way to do this is to buy investment quality bars from the Perth Mint or a similar bullion dealer. You can also buy gold coins from similar sources, but you'll pay a premium here. When I first started buying coins back in the 1980s, I was paying a premium of only a few percent. More recently, I've seen the same coins on sale at premiums of 30%. And, that's a big margin to be paying. You can also buy gold nuggets if you know where to go to get them, but here you are likely to be paying premiums of at least 100% and up to 500% if they are good specimens. Turning these back into cash is not always straightforward, as they are unique items and you may find that they're longer term investments than short term trades. If you're only mildly interested in profiting from a rising gold price, you could buy gold jewellery, but this would be of more interest in the ladies and I suppose some men who want to wear it. With all of these alternatives, you have a number of problems over and above the matter of premiums over intrinsic value. Where do you store it? What are the security risks? What chance is there of being subjected to fraud and counterparty risk? What's a practical denomination if you really want it for monetary value? In the case of a meltdown of paper currencies, it's hard to get change from a $3,000 piece of metal. If there really is a meltdown and gold is needed as a medium of exchange, maybe you should also be considering guns and swords. Gold is great, but there are pros and cons when you want the actual metal. Secondly, you can buy gold instruments, which could also be termed as derivatives. In this world of financial geniuses, it's possible to securitise anything, even dud housing loans, as the Americans so aptly showed us a couple of years ago. It follows that there are a number of financial instruments for playing the gold market, with the most traditional ones being gold futures. Profits can be huge, but so can losses. It's a gambler's arena at times. Option and warrants are better if you're looking for downside protection and you want to know the maximum you can lose, but the upside's reduced as well. Gold certificates give the advantage of holding gold without the storage issues, but there are associated costs and significantly there is counterparty risk. If the financial world breaks down, so does trust. I wouldn't trust that the custodian has the gold for immediate delivery when you want it. Maybe it does, maybe it doesn't. Personally, I wouldn't want to take that risk. Thirdly, if you have the expertise and the funding, you can trade in gold mining real estate. By this, I mean exploration or mining licences. You can do this on your own, in syndicates, with partners. Promoters will always be looking for licences to spin out IPOs. Maybe there is gold on them, maybe there's not, but there's always a level of trading and speculation going on. However, to do this, you need to have specialist knowledge, and this is not an option available to most punters, particularly if you're not operating in the Australian field. And fourthly, and this is what I'm really here to talk about to you today, you can participate in the gold bull market by trading gold shares listed on a recognised stock exchange. This is the easiest and most flexible method for Australians in particular, given the large number of ASX listed vehicles. Keep in mind though that a share in a listed gold company is in itself a type of derivative. We are comfortable with it as we have grown up with the concept of holding a piece of paper that gives us rights. We can trade those rights due to a sophisticated market with supporting legislation, but it is only of value if everyone plays by the rules and there is a sheriff to enforce those rules. Now, there are two reasons why anyone would want gold exposure per se. The first one is simply a matter of making money and human psychology without any great commitment to gold itself. If we think that someone or everyone else will want something, the laws of supply and demand will tell us that the item or commodity in question will go up in price, provided that supply is inelastic. We need to buy ahead of the pack. This applies to gold today. We see that there is strong demand for gold and that itself is a good enough reason to take a position. This principle is directly transferable to the share market, as frequently the only reason we need to buy a share is because we believe someone else is going to want it, and this usually overrides decisions based on fundamental value. As long as people want gold, the appetite will be transferable to gold equities, with one exception. But for the first reason to be sustainable, we need to get back to the reason why you would want the physical metal itself. Yes, we do have that reason now, as all the gold bugs in this symposium will be telling you. It's all about currencies, inflation and credibility of financial systems. If that second reason for wanting gold has merit and the fear starts to become a reality, and the only thing that will actually save us is gold, the metal itself. The first reason, a trading reason as far as it relates to gold shares, that will evaporate if the fiat currencies collapse. Yes, shares can be converted to cash, but it is the value of the cash that comes into question. The value of shares will become worthless unless they can be exchanged for gold. So, does that mean you should avoid trading in gold shares? Absolutely not. It is all about timing. Trade gold shares to your heart's content. For that matter, trade any leveraged instrument. For as long as you think you can settle your trades, build up your cash balances by all means, but you also need to know how to pick your timing and when to switch into bullion at the right point. Because if the disaster scenario really does happen, cash will be as valuable as a broken promise. In a perfect scenario, the gold price will soar. You will trade gold shares and make huge cash profits. And there will be some sort of solution that preserves the fiat currencies, albeit with some adjustments, and the financial systems won't collapse. So let's look specifically at gold equities and what you need to know. I'll assume that you all know how to buy and sell shares, so let's consider the risk profiles that you need to select. You can basically pick companies that are exploration, development or producers. Each of them will give a different rate of return associated with those risk levels. Typically, the exploration companies are viewed as high risk. They are frequently based on expectations and crystal balls, with promotion and arm waving playing a big part. But they can also be based on sound geology and science. You need to know which you are dealing with. Rising share prices based on promises are frequently bubbles waiting to burst. Shares may double or triple in price, but eventually there must be a reckoning. On the other hand, good science and analysis can identify stocks that can grow based on exploration success. The sky is the limit here, or should I say, geology is the limit. A piece of desert in Western Australia may be worth just a few dollars, but if there are some successful drill holes and there are 1 million ounces or more found, the value of the company could jump from 10 million to 100 million to 200 million and beyond. A 10 or 20 bagger over a 2 or 3 year period of time frame is not unusual in the exploration business, although it's usually someone else tends to make it, not yourself. Interestingly, over the past 6 months, we have seen the stock market investors showing a strong preference for exploration risk, to the extent that premiums have become realistic in some cases. A lot of the producers, and certainly the developers, have been overlooked in favour of the speculative activity on the exploration stocks. So how do we decide whether an exploration stock is expensive? It depends on its stage of development. Consider first the raw exploration company that has projects but no drilling. put aside any geological assessment and look at the market capitalisation and the cash. Here we have an example of a company which is basically a shell. It might be trading in the range of $5 or $10 million, cash of $5 million and no gold. Well, that's your starting point. What can it do with that $5 million? What's happened there? Where are the rest of the slides? Well, do you want to try and load it up again while I'm talking? Because I'm working through some examples here. Do you want to do that? Well, I've got it here. Well, I'll speak some numbers and the tables hopefully will come up shortly. Right, we're starting with a shell company, market capitalisation of 10 million. Assume it goes off and does enough drilling and probably spends in the order of $10 million, because a rule of thumb is that successful companies generally can come up with ounces of gold at $10 to $20 an ounce discovery cost. That's a reasonably proven figure. So the company goes off and it finds 10 million tonnes of resources at 1.5 grams to give it 500,000 ounces of gold. I picked that figure because that's a useful cut-off size below which a project would be considered small fry and not really worth worrying about for a lot of people. That discovery and the spending of $10 million could reasonably expect to take the share price from a 20-cent level to $1. A 500% increase, and it would probably have had to issue another 10 million shares along the way to fund that exploration. On that basis, the market capitalisation would be $60 million, so it's gone up from 10 million to 60 million, and the EV per ounce of the company would be $116 an ounce. That's a reasonable figure in the market today. A lot of exploration companies are selling between $50 $200 an ounce. The more speculative ones do get up to $300 and $400 an ounce, but you'd have to say that they're anticipating significant additional discoveries to justify that. Once you start with 500,000 ounces, you then start to convert that to a mining reserve. Assume a 60% conversion rate of the resources to reserves, and you'd end up with a mineable figure of 300,000 ounces, which could support a 40,000 ounce per annum gold mine for 7 years. 7 years is a fairly industry average magic figure that they like to aim for. Are we having any success?
Yeah, no, sorry.
All right, well, what we do when we convert the ounces to mineable ounces,
We're putting it up, Warwick, it's slightly different.
that's it's probably a bit small to read, isn't it?
Yeah.
That's the PDF? It's not on the...
Not on the PowerPoint.
I don't know what's happened there. All right, well, going from 500,000 ounces to a mineable reserve of 300,000 ounces actually increases the EV per ounce from $116 to $233 an ounce. That is a function, obviously, of just looking at your economic ounces. From this point, we move to the development scenario, but it's usually a point at which share prices perform in much more subdued levels. If you assume that the cash cost of the industry will be about $660 an ounce. Can we move on to the next slide, please? Which is definitely too small for you to read. You can blow that up a bit, can't you? Right, that's a bit better. You've got your market capitalisation. Remember, you started at $10 million with 50 million shares. Your share price has gone from 20 cents to $1. That's a 5 times return on your money. That's not bad. You're looking at a typical operation there, 40,000 ounces per annum. You're looking at a 1.5 million tonne per annum plant. That means the capital cost for the mining reserve is about $340 an ounce. Thus, it costs you $660 an ounce cash operating cost, and $340 an ounce your capital allocation cost. Basically, to produce an ounce of gold, it'll cost you $1,000. At the gold price of $1,400 an ounce, that gives a $400 an ounce margin, and the project could throw off $120 million in pre-tax, undiscounted cash flow over a 7-year period. If we can scroll down to the next one. That's the annual cash flow margin might be in the order of $30 million per annum. Remember, this company's capitalised at $70 million. Perhaps it should sell on a multiple equivalent to the mine life of 7 years, which would give it a market capitalisation of $210 million. In reality, it will trade somewhere in the range of the NPV to twice the NPV. So something less than $100 million in size to $200 million in size. Thus, from the starting point of $10 million, the company might grow to $100 to $200 million in size, and it'll issue a few more shares along the way, so there will be some dilution, but you still end up making 5 times your money. That's a good outcome, but how many people want to wait 3 to 5 years for this to happen? What the punters really want is the exploration upside, the sizzle. They want spectacular gain rather than a sound investment. This example shows you that the best return on your money is from the exploration phase, the first year or two, where while the drill rigs are turning and the exploration is going on, we could expect that share price to go from 20 cents to $1. Once it gets that level and you start doing your development, feasibility work and all that sort of stuff, the sizzle's gone and it becomes more of an investment, and the rate of return is nowhere near as good. Consider that once you get to that stage also, you have to go through commissioning risks, and not every project is engineered or designed properly. Not every project do they understand the geology properly. So it's a different level of risk. Up to 30% of mining projects actually never repay the capital due to a range of issues from geological, engineering and commodity prices. You need to look for other parameters such as mine paybacks. If a gold mine has got a mine payback, a capital payback of less than 2 years, that's generally pretty good. If you ever find a gold company with a payback period of capital of less than 12 months, that's excellent and you should go for it. If you compare that with some of the larger projects, copper, iron ore, base metals projects, quite often they'll get up and running when they've got a 4 or 5 year payback period, but those mines usually have 10 or 20 year mine lives. But anything less than 2 years for gold is generally pretty good. A production company is generally safer than an exploration or a development company, but it's more suited to serious investors seeking fundamental value, dividends and corporate activity, and producers are more suited to large institutional investors. I think that's right, that's the last slide. But just a few other comments to take into account if you're investing in listed equities. A full consideration of gold equities involves many other aspects. Equities do not protect you from counterparty risks. Best described as management risk. You're relying on a team of geologists and managers to look after your money wisely and correctly, and there's more than one or two examples of that not actually working in practice, because there's no shortage of SPIVs in the market. Experience will tell you who these people are, how to identify the SPIVs, how to identify the good operators, and certainly a bit of analysis comes in handy. So mining analysts, especially those with 10 years or more under their belts, will be valuable assistance in identifying the good stocks. However, there is a serious problem in the business that mining analysis has been dumbed down over the past few years with the introduction of PowerPoint presentations and cartoons. There is a risk of the blind or the incompetent leading the blind in the investment field. While considering risk profiles, it's also important to consider aspects such as geopolitical risk, though this is more often a matter of perception than real risk. The appetite of the market for this and other risk elements fluctuates with the stage of the stock market cycle. So in summary, investing in gold shares offers a real and commercial way to benefit from this gold bull market. If you don't mind geological risk being added onto the equation, exploration stocks can give you exposure not only to a rising gold market, but you can also get the turbocharge of discoveries. Personally, I can never see the sense of buying a gold producer that doesn't have any exploration or growth potential. There are obvious benefits offered by the settlement procedures of an established stock exchange, and in most cases there is acceptable or good liquidity. While the financial systems work and fiat currencies are good for settlement, investing in gold equities is an excellent and convenient way to profit from this gold bull market. So that's, I apologise for those slides not working properly. It would have been helpful to work through those examples, but hopefully I got the message across how you can actually see shell companies emerging into something of substance and how the share price should perform. And, that it's a proven formula. Thank you, ladies and gentlemen. Were there any questions that people would like to ask?
I think you stunned them into silence, Warwick. There's one just here. You got it? Hang on, it's not working. Sorry.
If I remember rightly, you were saying earlier that it's no good having a claim on gold, like a gold share or derivative of some sort, if it has blown up completely and you can't cash it. Just a suggestion here. My reading of history is that in most cases, if a country is independent, the matters won't go to the extent that they did in Germany in 1923. In most cases, I think there'd be a military takeover of the government, and while they probably would do a lot of things wrong, they would impose some sort of order on the fiat currency.
Well, we can hope that would happen. When Germany had its problems, it was an isolated country. If we are talking about collapsing currencies in multitudes of countries, that's a completely different situation. The important point to remember is that we all live in hope that the world keeps going, the finances hang together somehow, there's some initiative from a government or central banks. But, if we have what was happening in Greece earlier on this year across every country, you start to talk about the breakdown of democracy, and in situations like that, who's there to protect your currency? I don't think there's many people around. What I say is we can go ahead trading all sorts of instruments, equities, derivatives, whatever. So long as our settlement procedures are there to give us cash at the end of the day, then we should be happy that we can make profits. However, if the systems really break down and we go back to the, needing physical metal, all the cash in the world isn't going to help you. That's simply my point. When we had the global crisis, the global meltdown a couple of years ago, we were within 2 weeks, in my opinion, of social disorder and breakdown of the democratic systems of government. Within 2 weeks, and I was advising all our sales desk, well, you might as well go out and spend all your money, because if this goes on any longer, it's not going to be worth anything anyway. And those people who did that made a fortune buying at the bottom of the market. So just keep that in mind.
Well, one more. Yeah, we got time for one more or not?
Sure.
As long as it's, I think, a quick one then.
Warwick, for investment purposes, how would you compare a silver stock to a gold stock?
Well, the biggest thing about silver stocks in Australia is there are almost none. They are small, might be $50 million, $60 million in size at the moment, and there's not room for everyone to play. That's the big point. It's a sideline, it's an issue more for private investors, not serious institutions. So, really, that's the biggest difference. They can be great, but how do you get set?